Michael, we were talking about your report earlier in the show and sort of why the Saudi government won't weaponize oil. Can you walk us through it?
Sure. So, I mean, look, we've moved well beyond this time where they have an incentive to do that. There's too much that they stand to gain from their reputation as a reputable supplier of oil to, all the different markets. So I think from here, what we have to focus on is the potential for there to be a break-even price that's arguably higher than the $80 per barrel that Mohammed bin Salman and other senior government officials have been targeting for the last several months. And Bloomberg itself reported back in April that there was, comfortability with a higher price level. So now we have to wonder whether they're going to be comfortable with $90. Are they going to test that higher range? That's the key question we have to be wondering about, because it's clear that with foreign investment pulling out, with higher costs of operations and higher costs of supplying, that's the problem.
Well, and to that point, this is when the U.S. versus Saudi relationship comes into play, because if they have to buy weapons from another country, that could cost more. If they have less foreign investment coming into Saudi Arabia, they're going to need that oil money. And that's a very different circumstance 6 months ago when we're like, I don't know, do they like 80 or do they like 90?
Right. So I think that's the key issue. And I think the other thing we have to be cognizant of is as we move into this time frame where there's a lot of potential for further supply disruptions in Iran and in Venezuela, are we going to see them actually raise output next summer? There is always an increase in the amount of oil that's used domestically. So will they raise output up to 10.5 million barrels a day, or will they just keep it at 10 million barrels a day flat? If they keep it in that lower range, then we're going to end up with stock draws next summer at the very same time that Iranian supply is lower and Venezuelan supply is lower as well. Which
raises the question, is the U.S. going to be forced to grant waivers when they didn't want to when it comes to Iran?
So I think, look, what we've seen over the course of the last 6 months is a kind of evolution in terms of the policy of this administration. It's clear that at the outset it was we're going to zero, no exceptions. Secretary Mnuchin was over in Europe over the weekend and in the Middle East over the weekend saying, we are going to go to zero again. So I think it remains an open question, but it's clear that they need to at least issue some significant reduction exemptions for India, for China, as they, sort of test this higher range.
You have, for 2019, you have an average Brent forecast of 72. We also heard some things from Schlumberger on Friday talking about some execution issues in the Permian. Do you think you're going to have to revise that up? How much upside risk might we see in 2019?
So, we take a very fundamental view to how we look at the oil markets. And we see, as we look into next year, the supply and demand balance flipping back into surplus. Given that outlook, we cannot be of a more bullish view than we are right now. And we expect that we will see stocks starting to build again. And arguably, we could even see it as soon as the next quarter. So given that outlook, we continue to be of the view that prices need to stay in the range between 70 and 75. If, however, we see a disruption scenario that is more aggressive than what we are currently assuming, and by the way, what we are assuming is quite aggressive already. It's Venezuela below 800,000 barrels a day. Yeah. It's another 300,000 to 400,000 barrels a day lower for Iran. It's, a disruption assumed for Nigeria in the first quarter. So all of this we are trying to take into account, and we have arguably 1.4 million barrels a day of demand growth. And therefore, even despite those assumptions, we're still seeing builds.